Hey, thanks very much. Welcome back. 6 minutes past the hour. It is my pleasure to welcome back Chuck Malamut, the official financial advisor to the Hurley in the Morning program. To reach Chuck here is presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, do not necessarily reflect those. A solicitation for the purchase of or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. Chuck?
A little early,
Not last night.
But I will tell you what, if your listeners have the time and the wherewithal, I would. I thought that game was just a little boring, but anyway.
You like a lot of scoring?
No.
A lot of shots.
St. Louis, Chicago game last night was the dark days of despair again. And, every day you're looking and you're having thoughts that perhaps we will be back to where we were between, where you make it on the top line and miss it on the bottom line. There was, I don't remember, I saw it very early this morning, there was a company that's thrown on Apple.
I was going to say, they're going to get hammered.
There's discussion that revenues could be off, earnings could be off, 10% from where they were a year ago, nothing in the pipeline to speak of. Is this the same company that it was, a decade ago? So you hear that, continual in your, during our time together. But, yeah, I think that the fact that the 6 was so terribly successful, marketed correctly, and is a miss right now.
Yeah, I have to say, as far as products go, almost everything they've ever brought out. I love, the iPad, bought one. Mini iPad, bought one. iPhone, every time the new one comes out, I'm right there on the pre-order list, getting it day one. I had no interest in the iWatch. Now, in all fairness, I have a certain watch that I'm very fond of, and I wear it every day. So it could be I want to leave open the possibility that I just don't need it, but that never interested me. I find it too small. And
Harry, overall earnings per share are projected to be down about 5% here for the quarter. But if we took the energy out, I always like how, as you talk on, for you, unemployment at all-time low levels, an economy that, came out of 2008 and 2009 and it's doing wonderful. But we're not going to.
By the way, you can do that. You could say what the Dow Jones Industrial Average was, what the S&P 500 was in 2008, what it is this past Sunday that I put in my briefcase for this morning. And this is the same tune. It's almost like, it's like a broken record. Fed seems
increase rates.
What's going to be interesting, Chuck? And okay, so I'm going to go with the the other large percentage, the other 84% or 86%. 100 people in America doing what we did for a living then, and now there's 20,000 doing what used to be less than 100. But I remember saying, setting
aside the fact that it is a presidential election year, we're of the belief that the Fed's going to raise 2 times in 2016. So if you look back, Harry, for the last several years, the Fed has, pretty much, negotiated and navigated us through some very, very, challenging situations.
Would you say they've done a good job?
I think, Harry, I think they have done a relatively good job.
I do too. I think the one increase was a mistake. I think they committed themselves to something that was changing circumstances had occurred, but they were afraid to not do what they.
So the fact that it was broadcast for so long, it forced the Fed to make a move. So,
but you do agree, though, circumstances did change by the time they had done it.
Look at the stock. Look at what happened to the stock market.
Yeah.
Within a month period of time, what happened to the indices? You finished up January, the worst January in the history of the stock market. But putting that aside for a minute, for the last several years, the Fed has done a pretty good job stimulating economic growth. And help, take away all the deflationary pressures that were out there. So we think the economy is accelerating. Now, it's the matter how you define what acceleration means. And inflation is slowly rising, which the Fed wanted to have happen. So if, in fact, the numbers continue to come in as we anticipate, we think the Fed's going to continue that slow and gradual pace of rate increases. So the guesstimate is that they're going to come twice this year. Now,
twice in the presidential election year.
So
Wild.
you have U.S. domestic, which has done relatively better compared to international, and the concern of late has been the lack of global growth and the ongoing geopolitical risks that we are faced with on a day-to-day basis, to hinder the economic growth.
Let me read to you what I heard about this, and it really does mirror everything that your fine company's market research has yielded on their own. And when a lot of smart people look at something the same way, you sort of, I think, can come away from that believing that it is where we are, and this is what we are presently experiencing, and this is what we will probably experience. Here's what I read over the weekend. Many Fed officials remain spooked by the steep stock market drop earlier this year. You commented on that. And by weak first quarter U.S. economic data, you commented on that, concrete signs of higher inflation and growth may be needed before the Fed and their policy committee would do the projected gradual path toward more normal level of interest rates. But a couple other things I thought interesting here. Markets have already anticipated such an approach, and they were talking about some of the things about China's economy and, weakness in retail sales and international trade and some of these other things, which could make the Fed chair reluctant, cautious about any further rate hikes before the second half of this year, which will blow my mind because now you're the finance guy, I'm the political guy. So seeing increases in the second half of a presidential election year has not occurred in 25 years.
So we'll see.
One other thing, then we'll get to turn it right back to you. Here's the thing that also mirrors what you were saying. This particular source that I read said that there's just a 1 in 5 chance of a move at the next meeting on June 14th, June 15th. So there are 2 rate hikes this year.
So if it's not June and it's not April,
it's the second half.
And so we'll see if Janet Yellen gets summoned to. So
quiet.
Maybe they'll start tracking her, and if she gets summoned to the White House,
his briefcase. He would be walking across the street with the briefcase, and then a rate increase was coming. It's amazing in simpler times. Now it's all high tech and different. But what will be interesting, the geopolitical side of this is, and I know we don't. Well, one of them could be after the November election, I guess.
Yeah, I think that. If the stats that we're seeing come in continue, it's going to force the Fed to make a move because, as I said, unemployment is improving. You're getting wage increases, so you're seeing that pressure. You're starting to see oil prices, which we'll chat about a little bit, continue to move upward, which again creates a little more inflation. So the Fed wants inflation. So if they get the inflation, and they get the global growth back where it needs to be, then you're going to see these rate increases.
Halftime break. We're going to be right back. He is Chuck Malamut. Take a listen every Tuesday in the 8 o'clock hour, the official financial advisor for the Hurley in the Morning program in our 26th year together with Chuck, and he has a number of additional years in the financial services industry. On top of that, he's been with us in our 26th year together. He has beyond time in probably 6 weeks or more. The price of a gallon of gasoline actually came down. Our corner store went up as high as $1.99.9 for regular unleaded. As of this morning, it was $1.93.9, the first reduction that I've seen in a good number of weeks. I don't know if that's a trend or if that's just something that has occurred this week, but it is something that I took note of. Back with Chuck in just a moment, coming up after Chuck Malamut. One of the nicest people at the national scene that you'll ever meet. Janice Dean, nicknamed the Weather Machine, meteorologist for Fox News Channel. Absolutely terrific at what she does, and she has an incredible brand. She has this series of books, Freddie the Frogcaster. And the latest one is about tornadoes, and Janice is actually going to be going to areas where they've had tornadoes. It's really going to be a great 10 minutes that we spend from 8:50 until 9 o'clock right after Chuck. With Chuck Malamut, almost 34 minutes past the hour, so we have about a little over 10 minutes with Chuck for this morning. And remember, you can listen to Chuck every Tuesday morning for most of the 8 o'clock hour, and you can certainly reach Chuck and the entire Malamut Group at Morgan Stanley's Northfield office at any time, 609-383-2010. A very responsive team that really will do a great job for you. Tell them I sent you to the Malamut Group at Morgan Stanley's Northfield office. Chuck, are we going into gas prices now? Or
Yeah, sure, we can go there. Now, Harry, so the price of West Texas, as of last Friday, compared to where we were in December, 43.77 on the barrel versus 37.13, which represents an 18% increase. The price at the pump, 2.14 nationally, 2.14 versus 2.04, which represents a 5% increase. So the price of the pump has not kept up with the price of the barrel. Now, what is happening, with West Texas, as they move over to the summer blend, it becomes more expensive. So I wouldn't be at all surprised, Harry, if what you saw was more of an aberration.
Yeah. I was surprised to see it because it looked like we were in an environment where that wouldn't be happening. I was surprised.
So if you look at what has happened with oil in particular, it's pretty interesting because there was a lot of discussion that we had no demand, and virtually with no demand, the economy, basically falls off the cliff, and as a result of that, we saw back in the early part of this year.
I'm trying to remember. What's the least expensive that you saw a price? I know you don't use the unleaded. I don't use the unleaded. We use a higher blend, or higher brand. What's the lowest you saw the posted sign? Like $1.30?
I'm going to say I was going to maybe a little bit higher, maybe 140, somewhere in that range. But
yeah, I think it went below 140. But so I'll just say 140. So it's up over 50 cents a gallon, close to 60 cents a gallon.
Yeah. So if you take a look at what has happened with oil,
is that commensurate with the price change?
No, because
it never is it?
No, and usually what happens is the price of the pump moves hand in hand with the price of the barrel, and that has not kept pace here as we look at where we were back, year to date. Now, if you take a look at the increase in oil prices, one of the reasons is that the market dynamics that we look at every day has reversed itself in 2016. Portfolio managers, money managers, institutional investors, hedge funds are now taking a more bullish stance with respect to oil prices, Harry, in anticipation of potentially, what's going to happen with production. The meeting last week, everyone was expecting to put a cap. It did not happen. And as a result, when we got into the beginning of the week, oil trended down but quickly moved up, and so we ended the week with higher oil prices and higher equity prices.
Chuck, how big a deal, and I know this is not just a finance question, it involves your skill sets in business and industry, which is also, impressive, your pedigree. The fact that we now produce half of what we need every single day, I think that really has put us in a position where the rules are different now. We're not as reliant on foreign oil. And I think that's a big reason why the prices have come down. It's, it's a pure supply and demand economics 101. Your thoughts?
Well, Harry, the supply glut that we saw out there, in all likelihood, should rebalance itself as we get through 2017.
What about on the point, though, that we now produce half of what we need?
I think that from geopolitical risks, yes, we're not as dependent as we were previously, but unfortunately, we still need to depend on foreign sources of oil.
Would it be advantageous for America to consider trying to be self-sufficient, or it's not worth it?
Well, of course it would be, but you know
the economics and the environmental.
Yeah,
because we think about refinery capacity. That's really all that stops us.
I kind of wish we were on like a live video feed so your listeners can see our facial reactions as you ask the question.
Because I asked it.
You throw some. The answer before you ask the question, but that's okay, Harry. So I think that the oil market, we need to look past the failed agreement that did not happen last week. And the fact that we're going to have tighter balances in the future. So ultimately, while businesses and individuals are very, very happy with lower oil prices, I think they're not going to stay at these levels for too terribly long.
They're going to go up?
They will go up. And
Do you think they're going to go up substantial?
I don't know how you define substantial, but I will tell you.
Are we talking $3 a gallon oil? $2.50?
So if the national average is at a $2.14 right now, you need to. It's a pretty big move to get from $2.14 to $3.
Yeah.
In relatively short term. I mean, I'm going to, be a little conservative with the guesstimate, but Harry, I'm going to say 250, 260 in a not too distant future.
And we still on your show talk a lot about, and I mentioned it on Hurley in the Morning when you're not here, because this is something you taught me, the more than $1 billion of spending that's lost for every penny that a gallon of gas increases. That's
right.
That's major.
It is, and that's one. The Fed is getting back to, not to jump around, but the Fed wants, they want the inflation desperately to be able to justify.
Explain to people, why do they want inflation?
Because, Harry, that if you don't have inflation, there's no need to create an increase in interest rates. All right, you are at a zero-sum game.
Are they willing to force it, or will they let it happen?
No, I think they'll let the market do what it needs to do. Versus trying to force it, because unfortunately, you try to force an action, unfortunately, get a reaction which ultimately doesn't work. But
hasn't this been an extraordinary almost decade when you think about that? We've been at nearly a zero rate environment for almost a decade. That really is it is unprecedented. It's without comparison in the entire history of the country.
Yeah, and that's why the market is where it is right now. We're
is
looking,
it part of the reason why we only grow 1% or fractionally?
Yep. Harry, you look at the constraints that have been put on. All of us ended up having to write checks for the most part. Last week to be a participant in a U.S. citizen. And
April 18th.
Now there's all sorts of rhetoric as to what's going to happen, with the tax rate. So, you have to be able to feed that big beast down there, and who's going to pay for that? But you and me and all your listeners. So, but if you take a look at what has happened with energy, just kind of segue back there. Last week in itself, energy was the best performing sector of the S&P 500. As everyone is starting to realize that prices will in fact move higher. We did have a few bankruptcies, as the market wanted that to happen. Energy last week was up 5.2%. Financials weren't far behind, Harry, up a little bit less than 3%. If I asked you a question, I'll ask you a loaded question.
Okay,
because
thank you.
You'll know the answer already.
I'm going to try.
Was energy in the top 1/3 year to date sector returns in the S&P 500?
Well, my instincts would say, based on what we know, I would say yes.
Harry, you passed the test,
Thank
actually.
You.
So
I learned from you.
So actually, telecom is the number 1 year-to-date performer, and now energy is the number 2 performer.
Do you think a lot of people would not believe that, though? Do you think that's one of those ones that sort of surprises people?
I think a lot of people would be
thinking it was going the other way.
They'd be shocked when they understood that how well energy is performed. But think about,
I think it's like you said about banks. I think a lot of people are surprised how well banks have been performing.
Banks in the last several weeks are starting to work better, as the anticipation is that rates are going to increase, which helps their margin. So, but from a year-to-date perspective, unfortunately, financials are the worst performing sector of the S&P 500. So what the contrarian does is they look at the industries that haven't worked, and they typically try to overweight those industries. So several, not too terribly long ago, industrials and materials, they were beaten down sectors, and they have come back. But, bottom line, I think that the Fed is going to make a move, and they have to be.
When's the next time they meet after the June?
They'll come in September, I believe. It's cool. Well, they meet. They meet. I mean, they can announce at any point in time. They don't have to wait for a meeting.
Do you think though they would celebrate it sort of with the run up of a meeting, have a little anticipation, and do it like that, or would they be capable of doing it at any time?
Well, if you remember, Harry, several years ago, the Fed would basically, come at will, basically, and say, okay, we're going to increase rates. And remember, it got to the point where it looked like rates were moving. It was sort of like a staircase, upward staircase. Like every month you would be up 25 basis points.
Is that pretty much, though, when they were in a real environment of raising rates on a regular basis? If this is measured and really, calculated, it almost seems to me like they would do these at official meetings.
I think you're right. I think it's different now. I mean, the economy is not.
And if that is the case, they would be talking about a potential rate hike, the first one a couple of months before the election.
It's going to be very. I mean, imagine the dynamics here. If the stats come in,
and it probably will only be 25 basis points, right, Chuck? 50, 25?
No. I think when and if they come, they start with 25.
So it'll be almost next to nothing. But the perception of raising interest rates right before a national election, I think, is you would call it a geopolitical moment. You never know how that will be just
Harry,
processed.
Look at what the market did again in after the December meeting. So so if we look back at where the economy is, the data that we're seeing is choppy. Some reports are better, some are not. We think the U.S. economy is clearly moving in the right direction. It appears that the decline in oil prices was due more to a supply glut than the actual falling demand. So that's why the market is doing what it is today. There's two.
The program you just listened to was presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast, subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. When we come back in 2 minutes, Janice Dean, a very famous meteorologist known as the Weather Machine, Janice Dean, the Weather Machine from Fox News Channel, joins us next. I'll confirm it with Janice right on the air, but I believe this is her 4th book, and she has a great brand here with the Freddie the Frogcaster series. This one is Freddie the Frogcaster and the Terrible Tornado. And Janice has a great program that she's going to be doing in terms of her book tour, going to areas that are directly affected. Janice, coming up next.